April 1st, 2024. When you get a bear trend from the open, which is essentially classified as starts within the first 5 bars and lasts at least 20 bars, which is more or less what we got here, there's about a 60% chance that the market trades down and then just goes sideways the rest of the day. A 20% chance that the market trades down and you get some sort of reversal, like we tried with the big double bottom here, and a 20% chance that the market trades down and you end up just getting trend resumption. I had an example that I pulled up because I thought it was relevant. You can see that we essentially got a bear trend from the open and then a pullback to the moving average, and we tried to sell off again. And this is another example from last year where it was actually the pullback was very similar and at a very similar time. You can see the pullback here started on bar 31, pullback started on bar 31, pullback to just above the moving average, and then a sell off, pullback to just above the moving average, bar 41, sell off starts, bar 41, sell off starts. So very similar here. I think the big problem, the big difference was that this started to go sideways more before it continued down. And we tried to essentially get a climactic test down here and it didn't end up working out. So we ended up just going sideways. So I think, the big difference between those, I thought, it was more likely we were going to start to go more sideways to down and the market was going to try and trap out the bears so that it could continue down. But instead, too many bears wanted to get short and we started to get a climactic couple of bars and traders took profits. The market likes to mirror itself, as I've said a couple of times. And I thought there was an interesting example of that today. You can see bar 9 or bar 10 is essentially a spike. And then we got a pullback here and then a channel down to here. And if you take 2 times the measured move of the bar, or sorry, just using the body, get to about the low of the day, roughly. And then bar 48, spike, and then channel. And what do you think, the measured move it's going to go for is something like this, right? Maybe here. I think it was exact if you use tails, but almost exact. So the market likes to mirror itself, and we get a lot of those types of things in the stock market. And none of these spots where the market reverses are random. The first spot we got a bounce was the 14 low essentially. And what was it testing, right? There was no support from the prior day. So where were we testing? Well, we were testing this breakout point. You can see we got a big breakout above the high of the day. Usually a breakout above the high of the day is not going to go very far, but instead it trapped the bears. And so what happens here, the bears scale in higher, and you can see when we get back to their entry price, they exited. And, I already mentioned the low of the day, probably because of that measured move. And then we got a measured move down to the wedge, which is where this low was, basically the bounce here. And, it's not really important to know all that stuff, but what's important to know is that none of the places that the market reverses is random. It's all support and resistance of something somewhere calculated, maybe a different time frame, whatever. But it's just important to know that no move is random and there's always something happening. There's no such thing as just the market doing things randomly for no reason. There's always a reason for things. A bull bar on bar 1, but not really that good. You're opening in the middle of yesterday's bar, so it's really not excellent to be looking to buy or sell in here. I would rather wait and see what happens. Follow through on bar 2, but it's really not that good. There's big tails on bar 1, and there's big tails on both sides of bar 2 as well. So what's happening in these tails? It's not very good buy, and if you look at a lower time frame, what is it really? It's 2 legs up. So you can see the opening couple of bars here. We got 1 pullback 2 and a couple of legs up in a trading range. And you look at this and you can say, well, these just aren't good bars, so I'm not going to buy up here. But what's actually happening on those bars is it's a 2-legged move up towards the top of the trading range. So if you know that, again, it's not a good buy. It's not a good buy anyways because there's big tails on both bars, and you can see traders bought the 50% pullback of bar 1 rather than buying above it. But it's still important to know why that's happening. It's also, bar 3 essentially testing the top of this big sell climax bar. I think it was bar 78. And usually the tops of climaxes get tested and they become resistance. So really not all that great to be long up here. Outside down bar on 4, but not really worth selling anything. I think we're going to be sideways here. We could really break out in either direction. This still had some influence over the market. I think something like this could still have influence for a couple of days. So it's possible we rally, but at the same time, the context on the daily chart is very overbought. So you have to be aware of that as well. 5, a bull bar, small. It's a high 1 or a high 2 if you consider bar 3 the high 1, whichever one works for you. Not really a very good buy. Obviously, a doji on 5, a doji on 3, nothing all that great. 6, bad follow through for 5, a big tail on the top of 6. So again, not really all that great. It's a triangle forming, right? And usually if you get breakouts of triangles, you try to get measured moves. I don't know if we got a measured move down. We got almost exactly a measured move down. So oftentimes when you get, oh, that wasn't the exact high. I'm curious now. So yeah, why do we stop here? A lot of times when you get a triangle like this, you get a breakout and then a measured move of that triangle. It's common on all time frames, but even if you get like an 80 bar triangle, this was, a 4 bar triangle. But if you get like an 80 bar triangle, a 5 bar triangle, but if you get like an 80, 90, 100 bar triangle, you're still going to look for the measured move of that. It's always going to be important. And then a big surprise down on 7, bar 7. There's often surprises for like the report. And you can see we got a measured move down to that area where that was and around yesterday's close. A big bull bar on bar 8, but it's not really worth buying. I think big bar, big risk, and you're buying on a flat moving average. Bar 9 did something really interesting. It did not, if you look closely, it did not test the 6 low. Why is that important? Bulls bought the low of bar 6, and they were probably scaling in lower down here. If you bought bar 6, how does 7 make you feel? It sucks. You didn't want to see bar 7. You wanted to see, basically an outside up bar and us to rally and do basically the exact opposite of what we did here. But instead, we get a big bear bar on bar 7. So you're obviously disappointed. But the bulls who bought below 6 know they're going to be able to scale in lower, and they're hoping they're going to be able to make money. And what happened was traders were, this is pretty much the most disappointing bar you can get if you bought below 6. It really doesn't get a lot worse than that. And you can see the traders were so eager to get out that a lot of them sold out of their longs just before we got to that low. But some of them were holding, hoping we were going to get there. And when we didn't, a lot of the bulls started to panic out. So now you suddenly have a bunch of trapped traders, and that's what's causing bar 10 to be so big, is all of those trapped bulls. 11, it's a bull bar, and it's a potential wedge. 1, 7, and 11. It's a possible wedge and a possible low of the day, but I'm not really sure I want to buy it after the huge bar on 10. If you bought below 9, you're also extremely disappointed, right? Some traders bought below 6, some would have bought below 9 too. And those traders are really disappointed in 10. So I thought that, we were probably going to get, those traders were probably going to end up getting trapped. And it's notable that, or probably not going to end up getting trapped, but I thought they would probably sell out if we got back to the 9 low. And if you bought above 11, 80% chance, or if you were able to, 80% chance we would have gotten to here. But you can see those traders who got trapped pretty much ended up remaining trapped. I'm not really sure an area where they could have gotten out. Pretty much until the end of the day, unless you waited and bought here or here and exited during this, could be another reason for selling in here. But generally, if you take a reasonable buy, like buying below 9, it wasn't a good buy, but it was reasonable. 80% chance that if you scale in, you're going to be able to get out at break even and have the average price of your entries. 60% chance you'll get all the way back to the 9 low. So relatively high probability. 13, an inside bar. What is 13 trying to do? It's trying to get a breakout below this wedge and essentially reset the market cycle. It's 12. What is 12 trying to do? It's trying to get a breakout below this wedge, 1, 7, and 11, and 10, and get a measured move down and reset the market cycle. You can see the market tried to do it on 13, but we ended up getting a big tail on 13. Thought it was important that 13 didn't close below 11. That's really not that great for the bears. And then you end up getting a big bear bar closing near its low on 14. It's a really climactic bar, and we were testing, I thought this was going to be a magnet. And, if you're selling below 12, you're hoping for pretty much exactly this, some kind of dump. Most traders are not going to sell to close at 14 because you're so oversold. We're probably going to bounce. So this is an area of profit taking for the bears, and that's why you got the bounce there. 15, an inside bar, probably buyers below, probably sellers above. 16, another inside bar. A lot of times if you get an inside pattern after a sell climax, you're going to get a pretty large bounce. And generally inside after a sell climax, if you take the buy above 16, you're just going to set it and put a limit order or an exit order here, and just probably put a profit target up here or up here. And the market will usually, if it does trigger, it'll just trickle up for the rest of the day and try to trap you out constantly. So you're not going to buy above this expecting a rally straight up. That's one of those trades you take and you turn your monitor off and you wait to hear the ding on either side. 17 doesn't let the bar trigger. So always in bears are still theoretically in the market. 18, kind of bad follow through. It's a bar 18 reversal. So I think always in bears would probably get out above 18, but instead, again, doesn't trigger. Probably buyers below. You can see 19 failed breakout of the 18 bar range and a potential buy, but it's really not all that good. I think that you'd rather wait for a good bull bar. Do you exit above 19 if you're a bear? I think you exit a point or two above 19. So I thought a stop maybe a couple ticks above 18 was okay. Bulls would have exited above 18, but it didn't trigger. So I thought you could keep that stop. And you can see it never triggers. Traders end up defending that stop, and we get another leg down. 20, do you sell? It's kind of hard to want to sell down here, I think. So I would just let it go. Follow through 21, a big tail on the bottom. So really not that great. It's more of a sell to close bar than a sell below bar, but I'm not even sure it's a great sell to close bar. and you get big follow through on bar 22. And then you get a big outside up bar 23. 23 was a really small bar for the vast majority of the bar, but what ended up happening is bulls got eager, hoping it was going to close like right here essentially. It was, if you're watching, it was down here for most of the bar. And then the last minute, bulls started trying to front run the buy, because if it's a good close here, it's a reasonable parabolic wedge buy for a minor reversal at least, 10 bars, 2 legs sideways to up. But instead, too many traders bought it, and we ended up going outside up. When too many traders are buying signal bars and it's making it difficult to trade, what are you probably in? Probably a trading range. Bull bar on 24 and, consecutive bull closes. But look, we go up on 23, a big tail on the top, so selling, and then up on 24. So it's a two-legged correction in a bear trend. So you don't really want to buy above 24. You don't end up getting the chance because, the trade ends up, 25 ends up closing near its low and it never triggers 24. Can you sell 25? It's not great that it triggered the low one on 24. You probably prefer this to be an inside bar because now 24 is your signal bar for the low one. You probably can sell 25 for always in short, but I'm not sure how much further down we're going to go. And you can see 26 tested all the way back to the 24 close and then sold off, causing 26 because the bulls who bought the close of 24 got trapped, scaled in lower, and they were able to get out. Do you sell below 26? I think you're just playing with fire if you're selling that low. You're hoping that this is going to happen immediately, but you're probably going to get trapped out above 27. I can't really imagine you're going to sell here and stay short on 27. Outside up 28, probably disappointing. And then a huge bear bar closing near its low 29, follow through 30. So, at this point, I wouldn't be selling. It's another wedge, right? So we got this wedge, and then we reset the market cycle. And now we're getting a new wedge, 14, 23, 31. So it's a second wedge. And, probably better to just be flat at this point. Again, same problem as 2023. We get a big outside up bar on 31. You buy above 31. It's a really big bar with really big risk. So I think it's pretty hard to want to buy above 31 when we haven't had to close above the moving average in quite a while. Follow through for the bulls on 32, but that's, is that really what you wanted to see if you bought above 31? Not really. That 31 was probably the spike, and we're probably just starting the channel phase now. So I don't know. Maybe we ended up getting a measure move. I haven't looked, so I have no idea. But maybe we got a measure move up the sides of the bar, which is actually almost exactly what we got because bulls buy there. They get their 1-to-1. They get out. Inside bar 33, but you're buying right at the top of the most recent sell climax, the 29 high. There's going to be some sellers there, and you can see there was during 34. So any bulls who are buying up here, disappointed in this, scaling in, getting out up here. Probably buyers below 34 during 35, consecutive doji bars. It's really not that great to be doing anything in here. Bull bar 36 and follow through on 37. This is a bull, reasonably tight bull channel, but I think that the upside is pretty limited here. And then, an outside bar 38. I think we're just going to go sideways. At this point, what am I looking for, right? I think you should be looking for either, some sort of pullback and then a reversal up, or for us to start to sell off. You can see, I thought 41, you could sell 41, but it's a tight trading range and this is a pretty tight channel. So I thought better to wait for a bar like 42. It was kind of funny. I was actually, I thought this channel was a bit tight and it might be kind of hard to look to sell. And then I literally pulled up my example and I was like, well, that was a decently tight channel too. So probably okay to look to sell. And even if it's lower probability, you're trying to make probably at 10 or 11 points and you're only risking, 2.5. So 4 or 5 to 1 risk reward, pretty good. Follow through for the bears on 42 and 43. We got just basically a doji bar 44, not really that good. I thought, once we got 44, we were probably going to try to start to pull back and form some sort of lower high and then start to trade towards the new low. I thought we were going to get to the new low today. This is one of those days where we broke out of the 18 bar range, which there's a 90% chance of, but we did not break out of the 36 bar range, which there is an 82.5% chance of. But 45 ends up not closing all that strong. And instead, the bulls, hoping that was going to be a strong close on its high, they don't get it, and they end up exiting, causing 46 to close near its low. I don't know if we got some sort of leg 1, leg 2 here. You can sell 46. Yeah, so something like that. So leg 1, pull back, leg 2. You can sell the close of 46, hoping we're going to at least test the 30 close, which I thought there would be some support at the 30 high since bears sold above it, but we went right through it. And then there ended up being support at the 30 close. Again, I thought we might end up getting to the low and follow through on 47. And this is kind of where I messed up today. The market always makes you do the opposite management that you should be doing. But just thinking logically, so I sold 12 and, I sat through 13, but I did not like that it did not close below the 11 low because I thought this trade should go relatively quick if it was going to go. And it went on the next bar, but as this bar was kind of, in here somewhere, it took a couple minutes for this bar to start to sell off. And about 2 minutes in, it was not selling off. And I was getting disappointed. And I just exited because I thought too likely that we were going to get a wedge and a reversal up. And it was pretty hard to get back in. But why exit there, right? Because your risk, even if we bounce here, your risk is relatively small. So if you're sitting in the trade and let's say it's right here and it's not doing what you want it to do, it's possible you get a bull bar closing somewhat near its high, but it's only probably going to close like here at, worst case. So you're risking this much. And what's your reward potential? Well, your reward potential was pretty huge. I knew that. But as you can see here, your reward potential was pretty huge. You probably wouldn't have been stopped out until somewhere in here. So your reward potential was pretty big and your risk wasn't all that bad. So it makes more sense to sit in this swing and just let it go. I also sold bar 42 and I thought we were probably going to test the new low. And I was staring at the close of 47 thinking this was too climactic, but I thought we were going to get to the new low. I should have just exited a piece of it. And instead I sat in the trade and I just ended up exiting up here. But I thought, so if I was trying to get the market to right here, right? This is where I wanted the market to go to exit that piece of that short. And instead we end up getting a big outside up bar and I exit up here. So it might be high probability of us getting to here before we get up here, but the risk is super big and the reward is pretty bad. And so that's why a lot of traders, that's why this bar happens, because traders see that and they just get out. And they know the bears who sold 30 are disappointed in this and they start exiting. So 47, a climactic bull or climactic bear bar, one of the better looking bars deep in this channel. So, here the risk reward is bad and the probability it's good, but it's not worth staying in, versus here, the risk reward is good and the probability is not all that great, but that's the trade you took if you sold 12. So that's kind of my thoughts on, bad management today. Outside up bar 48, a good bull bar. It's a big double bottom with 31. Essentially, possible major trend reversal. Here's your trend line break, double bottom, major trend reversal 48, but a huge bar. Bulls probably going to try and buy 50% pullback instead, but you can see it never quite got there. So they were so eager to buy, they bought a little bit before the 50% pullback. 49, a bear bar closing near its low. It's a potential short for the bears, hoping, to get trend resumption down, but it never triggers. Disappointment, 50. So bulls bought the close 59. But some bulls bought above 48, scaled in lower, and were disappointed, so they're selling out, causing the big tail. 50 also tests essentially the high of 46, which is the top of the buy climax, or top of the most recent sell climax. 51, a big bull bar, but tail on the top, not all that good. It's a potential low too below 52, but I thought the channel up was too tight. I get the argument that it's 2 legs up, but it's a it's a 4 or 5 bar micro channel, so it's really not all that good. At this point, what are you looking for? You're looking for a surprise in either direction. So we start to go more sideways, 53. Again, really not all that good. We're probably going to test up to 51 close. You can see we were to spike and then channel. We tested towards the bottom of the channel during bar 53. 54, an inside bar, but that's not a surprise. I wanted to see a surprise, and we didn't get it. 54. 55, good bull bar, but you're right at the 51 close. I'm not buying this close. Again, it's not surprising. I need something good. And it's a potential wedge, 1, 2, 3. So really not that great. 56, potential, low too short. You could argue it's a wedge, but a truncated wedge, but it's really not all that good. I need, I want a surprise in either direction. 57, if 57 is a good bear bar down here, then I'll sell it and I'll look for a swing down. Or if 58 ended up being follow through, I would have sold that too. But instead, it's a disappointing bar, and all the bears who front run it were disappointed in how 57 closed. They exit, and that causes the big bull bar 58. What do we have? We have a wedge and a breakout attempt 58 above a wedge. And where does the measured move lead to? Leads to right around the close of bar 15. And what was the close of bar 15? Well, it was potentially the start of this trading range. So I thought it was pretty possible. We got another spike here, and now we're getting a channel. Maybe we get all the way back up to the top of the channel, the 15 close, which is right around where the measured move was. So it made a lot of sense for us to get there. 58, good bull bar. I think a good bull bar to buy above. Follow through 59. Again, 58's a surprise, right? It closed stronger and bigger than you were expecting it to. So okay to buy above 58. Follow through 59. Not as good as you want, but still okay. An inside bar 60, bull's probably willing to exit below 60 if it triggers. And instead, you get an inside bar 61. So it's an II pattern, a potential final flag for the bulls. And we could be forming some other type of wedge as well with 51 and 60. 61 a bull bar, not able to close above the 59 high, which I thought, or 59 close, which I thought was important. The bulls who bought this close, they're probably disappointed in 60. So the question becomes, are they going to sell out of their longs on the rally, or are they going to end up exiting? And that's what's going to cause this. You can see like over here, where was it? Yeah, here. So they bought here, they were disappointed, and you can see when it got to their price, they just exited. And instead here, they decided, it's kind of it's still good for the bulls that 61 was a good bull bar, but if it closed a tick higher, it would have proved that these bulls were more interested in buying more at this price than selling. You're looking for a give up bar at this point. This was a bull surprise, and you want to see the bears just give up and we start to rally, but it doesn't seem like we're getting it. And you get disappointment, 63. 62 is good, but I think it's kind of similar. You're getting follow through, but you still need the give up bar and you haven't gotten it yet. Disappointment 63, and then 64, a bear bar. I would probably just get up below 64. It's a wedge, 51, 59, 63. So I would just get up below 64. Disappointment 65, just a doji bar. Now we're in a trading range. I think the bull edge is mostly gone. Breakout attempt down 66, but then instead a big reversal up 67. Can you buy above 67? You probably can, but it's a tight trading range, and this is the problem. If you're buying above 67, a lot of times 68, it looks like some sort of, 1 foot in the door, 1 foot out kind of bar where it's follow through, but it's not really what you want. You wanted a bigger bull bar and you're not getting it. So a lot of traders end up exiting, causing 69, a couple legs down. And once we started to get this, again, I reverted back to over here, but now we're later in the day and it's, again, 60% chance you're going to go sideways. So I thought a trading range was pretty likely towards the end of the day. So now I don't need a surprise. I need a surprise with follow through, right? Here, I just wanted a surprise and we could potentially get a swing, but now I'm starting to get very picky trading this late in the day. So you're going to need follow through. And we never ended up getting it. Stop orders on the day. I thought 12 was good. You could probably take 25, but kind of hard to do. You can maybe buy above 31, but it's a wedge, but kind of just difficult to do with the bar being so big. You can maybe sell 41, definitely 42, 43, 46. I don't know if I would sell 47. You're pretty low. And then a big reversal up 48. Again, you could probably buy, but still big bar, big risk, so hard to do. I wouldn't buy again until 58. You could probably take 67. Maybe you could take 61. It's still always in long and a bull bar closing your tie, so it's not bad. And you could probably buy above 67, but tight trading range, I'd rather wait for follow through, and that's really it. On the daily chart, we're essentially, it's follow through for the double top for the bears from this and that. So we're still on the sell. Bears want to break out below the neckline, which is right here, and they want good follow through tomorrow. We'll see what they get. I don't think that we're going to get a big bear trend day tomorrow. It's low probability. I think it's, when you get a bear trend from the open, 60% chance, only 25% chance of another follow through day. So another big bear trend day tomorrow, 75% chance of at least 2 hours of sideways to up trading starting at the end of the second hour. But tomorrow morning, 50% chance that we resume the selling. So you have to be careful. If we start to sell off, it could easily be a sell vacuum test on the open. So you do have to be aware of that. But daily chart, bears want follow through below the neckline. Bulls want, this to essentially be a pullback from the high one, and we get essentially another high one here, but I'm not sure it's going to happen. Weekly chart, I'd imagine we're going to get a bear close. The question becomes, are we going to get below last week's low? Maybe form some sort of outside down bar if we start to rally a little bit. It's a new month, and we got another bull close on the last month. We're probably due for a pullback pretty soon here, but it's a buy to close rally. So, we could easily continue to rally. But yeah, that's the day.